Good day, Sir Horel, and to everyone. We are Group 2, and we are composed of four members, uh, namely Sir Jeb Calonia, Sir Anthony Cordova, Sir Jonas Bongo, and yours truly, Marvin Abrigala. So, we will be reporting about the topic 3, cost behavior and cost volume profit analysis. I will be reporting about the cost behavior. So the objective of this topic is to classify costs as variable costs, fixed costs, or mixed costs. To start with, let us first define what is cost behavior. So cost behavior is the manner in which cost changes as a related activity changes. So the behavior of costs is useful to managers for a variety of reasons. For example, knowing how costs behave allows managers to predict profits as sales and production volume changes. So knowing how costs behave is also useful for estimating costs, which affects a variety of decisions, such as whether to replace an equipment. So understanding the behavior of a cost depends on the following. First, identifying the activities that cause the cost to change. So these activities are called activity bases or activity drivers. And second, specifying the range of activity over which the changes in the cost are of interest. And this range of activity is called the relevant range. To illustrate, let us say that a hotel is concerned on planning and controlling its food costs during breakfast. So a good activity base here is the number of guests availing breakfast, included bookings, plus those walk-in guests who opt to have their breakfast in the hotel. We cannot use the total number of guests across the board since some of the guests did not include breakfast in their booking. So once the activity base is identified, food costs during breakfast can be analyzed over the range of guests who normally avail the breakfast included in their bookings. So this is called the relevant change. Costs are normally classified. So the classification of costs are first, variable costs, second, fixed costs, and third, mixed costs. Let us define first what is uh, variable costs. So variable costs are costs that vary in proportion to changes in activity base. So when the activity base is units produced, then the direct materials and direct labor are classified as variable costs. Uh, to illustrate, let us assume that Jason Sound Incorporated produces stereo systems. So the parts for the stereo systems are purchased from suppliers for $10 per unit and are assembled by Jason Sound. So for model JS-12, the direct materials costs for the relevant range of 5,000 to 30,000 units of production are as follows. So as shown So the variable costs have the following characteristics. So the cost per unit remains the same regardless of changes in the activity base. So for JSON sound, units produced is the activity base. For model JS-12, the cost per unit is $10. And the total cost changes in proportion to changes in activity base. So for model JS-12, the direct materials cost for 10,000 units, which is equal to $100,000, is twice the direct materials cost for 5,000 units, which is equal to the total cost of $50,000. So Exhibit 1 here illustrates how the variable costs for direct materials for model JS-12 behave in total and on a per unit basis as production changes. So the first graph here is the units produced, which is the model JS-12 versus the total direct materials cost. So notice here that as the units produced increases, the total cost also increases. So this is directly proportional. Meanwhile, for the graph, units produced versus the direct materials cost per unit, uh, the direct materials cost per unit remains the same regardless on the increase of the units produced. So, uh, in Exhibit 2, uh, these are some examples of variable costs and their related activity bases for various types of activities or businesses. So, first, uh, in a university type of business, uh, the instructor salaries are variable depending on the number of classes. And for a passenger airline, uh, the fuel cost is variable depending on the number of miles flown. And also in the manufacturing business or manufacturing industry, the number of units produced, uh, the number of units, the more number of units produced, the direct materials cost will be variable and will be more. Next is the fixed costs. Fixed costs are costs that remain the same in total amount as the activity base changes. So when the activity base is units produced, then many factory overhead costs, such as straight line depreciation, are classified as fixed costs. To illustrate the fixed costs, uh, let us assume that Minton Incorporated manufactures bottles and distributes perfume. So the production supervisor is Jane Suvisi, who is paid the salary of $75,000 per year for the relevant range of 50,000 to 300,000 bottles of perfume. The total fixed cost of $75,000 does not vary as production increases. As a result, the fixed cost per bottle decreases as the units produced increases. So this is because the fixed cost is spread over a larger number of bottles. So this is the table. uh, where we can find the number of bottles of perfume produced, then the salary of Jane Zovisi, and the salary per bottle of perfume produced. So, as shown, fixed costs have the following characteristics. So, cost per unit decreases as the activity level increases and increases as the activity level decreases. So, for Jane Sovisi's salary, the cost per unit decreased from 1.5 US dollars to 0.25 US dollars. So 1.5 US dollars, which is 50,000 bottles produced, and it decreased to 0.25 uh, dollars for 300,000 bottles produced. So the total cost remains the same regardless of changes in the activity base. So Jane Sovisi's salary of $75,000 remained the same regardless of whether 50,000 bottles or 300,000 bottles were produced. So Exhibit 3 illustrates how Jane Sovisi's salary, the fixed cost, behaves in total and on a per unit basis as production changes. So as we noticed here in the first graph, the total fixed cost graph, this is a graph between the units produced and the total supervisory salary. So notice here that the salary is the same or fixed regardless uh, of the number of units produced. And for the second graph here, uh, it is a graph between the units produced versus the supervisory salary per unit. So it is shown here that as the units produced increases, the supervisory salary per unit decreases. Some examples of fixed costs and the related activity bases for various types of businesses are shown in Exhibit 4. So, for the university type of business, regardless of the number of students, the building depreciation remains the same. And for a passenger airline, regardless of the number of miles flown by an airplane, the airplane depreciation remains the same. Same with under the manufacturing business, uh, the number of regardless of the number of units produced, the plant manager salary remains the same. And for hospital business, regardless of the number of patients, the property insurance or the hospital insurance remains the same. The same with the hotel uh, business, regardless of the number of guests, the property taxes remains the same. And also for the bank industry, regardless of the number of customer accounts the bank has, still the branch manager salary remains the same. Let's move to the mixed costs. Mixed costs are costs that have characteristics of both a variable and a fixed cost. So sometimes this is called semi-variable or semi-fixed costs. Uh, mixed, mixed costs illustration. So assume that Simpson Incorporated manufactures sales using rented machinery. So the rental charges are as follows. So the rental charge is equal to $15,000 per year plus $1 for each hour used in excess of 10 hours. So the rental charges for various hours used within the relevant range of 8,000 hours to 40,000 hours are as follows. So this is the hours used, 8,000 to 40,000. Then the rental charge, since for 8,000 hours, since uh, it is within the 10,000 hours, so the rental charge is $15,000. So next, for 12 hours, since it already exceeded 10,000 hours, so the excess number of hours will be multiplied by $1, which is equivalent to $2,000 plus the rental charge for 10,000 hours, which is 15,000. So the total will be $17,000. So for 20,000 hours, uh, uh, the the excess is the excess for 10,000 hours is 10,000 hours. So uh, the excess hours times $1 is equivalent to $10,000 plus the rental charge for 10,000 hours, which is 15,000. So it is equal to $25,000 and so on. So Exhibit 5 uh, shows the graph here on the total machine hours versus the total rental costs. So you can see here that the rental cost is fixed until 10,000 hours, and it became variable in excess of 10,000 hours, which is as per the rental charge, it is $1 for each hour used in excess of 10,000 hours. For the purposes of analysis, mixed costs are usually separated into their fixed and variable components. So the high and low method is a cost estimation method which uses the highest and lowest activity level and the related costs to estimate the variable cost per unit and the fixed cost. So to illustrate the high and low or the high-low method illustration, uh, assume that the equipment maintenance department of Quezon Incorporated incurred the following costs during the past 5 months, from June to October. So we can see here from June to October, these are the units produced and the total cost for each month. So the number of units produced is the activity base, and the relevant range is the units produced between the months June to October. So for Quezon, the difference between the units produced and the total costs at the highest and lowest levels of production are as follows. So the highest level is in the month of August, wherein the units produced is 2,100 and the total cost is $61,500. So, and the lowest level is in the month of October, which is 750 units produced, and the total cost is $41,250. So, the difference between the highest and lowest level for the units produced is 1,350 units, while the difference between the highest and lowest level in the total cost is 20,250. So variable cost per unit will be solved using the formula the difference in total cost divided by the difference in units produced. So the difference in total cost is 20,250 divided by the difference in units produced, which is 1,350 units, and this is equal to $15 per unit. The fixed cost is estimated by subtracting the total variable costs from the total costs for the units produced. So this is the formula. Fixed cost is equal to total costs minus the quantity of variable cost per unit times the units produced. So the fixed cost is the same as the highest and the lowest levels of production as follows. So for the highest level, which is 2,100 units produced, the fixed cost is equal to the total cost, which is 61,500 minus the variable cost per unit, which is $15, times the units produced, which is 2,100 units. And this is equal to $30,000. And for the lowest level, uh, the fixed cost is equal to the total cost, which is 41,250 minus the quantity of variable cost per unit, which is $15 times 750 units, which is also equal to $30,000. So the total cost will be the variable cost per unit times units produced plus fixed costs. Uh, so the variable cost per unit is $15 times the units produced plus $30,000. So to illustrate, uh, the estimated total cost of 2,000 units of production is 60,000. So this is the computation. Total cost, which is equal to the variable cost per unit, which is $15 times 2,000 units plus $30,000, which is the fixed cost, will be equal to $60,000. So this is how high-low method is being done. So let's move now to the summary of cost behavior concepts. So the cost behavior of variable costs and fixed costs is summarized here. So for variable costs, the total amount, under the total amount, it increases and decreases proportionately with activity level. And for the per unit amount, it remains the same regardless of activity level. So for the fixed cost, the total amount remains the same regardless of activity level, while the per unit amount increases and decreases inversely with activity level. So the mixed costs contain a fixed cost component that is incurred even if nothing is produced. So for analysis, the fixed and variable costs of mixed costs are separated using the high-low method, which I illustrated a while ago. So these are some of the examples of variable costs, fixed costs, and mixed costs for the activity based of units produced. So for variable costs, those are direct materials, direct labor, electricity expense, and supplies. And the fixed costs are the straight line depreciation, property taxes, production supervisor salaries, and insurance expense. While the mixed costs are the quality control department salaries, the purchasing department salaries, the maintenance expenses, and warehouse expenses. And moreover, one method of reporting variable and fixed cost is called variable costing, also known as direct costing. So under variable costing, only the variable manufacturing costs, direct materials, direct labor, and variable factory overhead are included in the product cost. The fixed factory overhead is treated as an expense of the period in which it is incurred. Also, variable costing is the cost of goods manufactured is composed only of variable costs. Thus, the cost of goods manufactured consists of direct materials, direct labor, and variable factory overhead. So, these are all about my topic, and thank you, everyone. So, I will turn you over to our next reporter. Thank you.
Good day, classmates. Good day, Sir Dave. My topic for today is about the cost volume profit relationships. So, under which we have the cost volume profit analysis. So, cost volume profit analysis is the examination of the relationships among the selling prices, sales, and production volume, cost, and expenses, and profits. Cost volume profits analysis is useful for the managerial decision making. With some of the ways cost volume profit analysis may be used, including the following objectives. First, we have to analyze the effects of the changes in selling prices on profits. Second, we have also to analyze the effects of the changes in cost on profits and to analyze the effects of changes in volume on profits. We have also to set the selling prices, to select the mix of product to sell, and to choose among the marketing strategies. So contribution margin, it is the excess of sales over variable cost computed as contribution margin equals the sales minus the variable cost. So assume the following data from Lambert Incorporated. Lambert has sales of 50,000 units. Sales price per unit is $20. Then variable cost per unit is $12. And Lambert has fixed cost of 300,000. So to illustrate an income statement for Lambert Incorporated is prepared in this contribution margin format. So to remember that Lambert has 50,000 unit uh, multiplied to the $20 per unit. So it will result to $1 million sales. So Lambert has also the variable cost of $12 multiplied to 50,000 units. So Lambert has $600,000 So since the formula of the contribution margin is uh, sales minus the variable cost, so Lambert contribution margin is 400,000. So Lambert has fixed cost of 300,000. So Lambert has the income from operation of 100,000. Contribution margin ratio. It is most useful when the increase or decrease in sales volume is measured in sales dollar. In this case, the change in sales dollars multiplied by the contribution margin ratio equals to the change in income from operation, which is computed as follows. So contribution margin ratio is equals to contribution margin over sales. So the contribution margin ratio is 40,000 for Lambert Incorporated, which is computed as follows. So contribution margin ratio uh, equals the contribution margin of 400,000 over the sales of 1 million dollars. So the result is 40. Lambert has 40,000 contribution ratio. Next, we have also the change in income from operation, which is computed as is equals to change in sales dollars multiplied to the contribution margin ratio. So to illustrate, if Lambert adds $80,000 in sales from the sale of 4,000 units, each income from the operation will increase by $32,000, which is computed below. Change income from operation is equals to change in sales dollars multiplied to contribution margin ratio. So change in income from operation is 80,000 times the uh, contribution margin ratio equals to $32,000 if Lambert adds 80,000 in sales from the uh, sale of an additional of 4,000 units. So the preceding analysis is confirmed by the contribution margin income statement of Lambert that follows. So sales of 50,000 since Lambert added the 4,000 units. So we have to multiply it by 20 as the selling price per unit. So we have the total of $1,080,000. So the variable cost for Lambert, we have to multiply it by 12. So we have $648. So list uh, the contribution margin is $1,080 list 48 $648. We have total of $432,000. So we have to list the fixed cost of Lambert of amounting to 300,000. So the total income from operation is 132,000. So the unit contribution margin is equals to sales price per unit minus the variable cost per unit. So the unit contribution margin is also useful for analyzing the profit potential of proposed decisions. So the unit contribution margin is computed as follows. Unit contribution margin equals to sales per unit minus the variable cost per unit. So to illustrate, if Lambert Incorporated uh, unit selling price of $20,000 and its variable cost of 12,000 $12. So the unit contribution margin is $8, which is the unit contribution margin of 20 minus 12 equals 8. The unit contribution margin is most useful when the increase or decrease in sales volume is measured in sales units quantities. In this case, the change in sales volume units multiplied by the unit contribution margin equals the change in income from the operation computed uh, in this slide. Change in income from operation equals the change in sales unit multiplied to the unit contribution margin. So to illustrate, assume that Lambert could be increased by 15,000 units uh, from 50,000 units to 65,000 units. So Lambert would increase from would increase from by 120,000 uh, 15,000 units times $8. So uh, this is computed below. The change in income operation is 15,000 multiplied by the uh, unit contribution margin of $8, which result to $120,000. So in this exhibit, the preceding analysis is confirmed by the contribution margin income statement of Lambert. So that follows, which shows that the income increase to 220,000 when 65,000 units are sold. The income statement in exhibit indicates income of 100,000 when 50,000 units are sold. So thus selling in an additional of 15,000 units increase income by $120,000. So this $220,000 minus $100,000. So this is uh, income by $120,000. So again, we have 65,000 times 20 equals to $1,300. So 65. So saan natin kinuha yung bakit nagiging 65? Because Lambert has additional of 15,000. So times the variable cost of $12, we have 780. So therefore, the contribution margin is equals to 1,300,000 less 780,000. So we have the contribution margin of 520,000. So pwede din nating i-compute na uh, the variable cost uh, multiplied to the unit contribution margin of $8. So it's equal to $120,000. So since Lambert has 300,000 fixed cost, so Lambert has the income from operation of 220. Uh, that is, this is the result when Lambert having the additional uh, units sold of 15,000 units. So uh, that's all for the unit contribution margin. So we have also discussed the mathematical approach to cost volume profit analysis. So we have here the break-even point. So break-even point is equals to revenues equals cost. So revenues is equals cost. So that will be a break-even point. So the break-even point is the level of operation at which a company's revenues and expenses are equal, as shown in exhibit, that the break-even uh, a company reports neither income nor a loss from operation. So equal yung revenues natin, yung kita natin is equal lang doon sa gastos natin. So walang profit. So the break-even point in sales is computed below. We have the break-even sales units is equals to fixed cost over the unit contribution margin. In this exhibit, to illustrate, assume the following data for Beaker Corporation. So Beaker has the fixed cost of $90,000, while the unit selling price of $25, and we have also the variable cost of $15. So the unit contribution margin will be the $10. So the break-even point for Beaker is 9 units. Bakit? Break-even sales equals to fixed cost over the unit contribution margin of $10. So 90, the fixed cost of $90,000 over $10,000 is equals to 9,000 units. Ibig sabihin na yung break-even point ni Beaker is doon maglalaro sa 9,000 units. So the following income statement of Beaker verifies that the break-even point of 9,000 units. So, i-probe natin bakit 9,000 units yung break-even income, break-even point ni Beaker. So, sales of 90,000 times the selling price of $25. So, Beaker has a total of $225,000. So, mayroon siyang variable cost na 15. So, $135,000. So, we have the net contribution margin of 90,000. So, since si Beaker has also the fixed cost of 90,000, so walang income si Beaker. So, zero. So, equal. Kasi the contribution margin is equal to the fixed cost. As shown in the Beaker statement, the break-even point in sales dollars can be computed below. So, the contribution margin for Beaker is 40,000. So, assuming na 40,000 yung contribution margin ratio niya. So, contribution margin ratio, bakit na mayroon siyang 40,000 40,000 40% na margin ratio is this is it. The contribution margin ratio is equals to the unit contribution margin over this unit selling price, which is 10 divided by 25. So that is why the contribution margin ratio for Beaker is 40%. Thus, the break-even sales dollars per Beaker of 200, 200, so $225,000 yung break-even point sales in dollars per Beaker. So, bakit mayroon siyang 225? Kasi break-even sales dollars is equals to 90,000 dollar over the consumption margin ratio of 40%. So, the contribution, the break-even point sales in dollars, we have $225,000. So, the effect of changes in fixed cost. So, change in fixed affects the break-even point. So, fixed cost do not change in total with changes in the level of activity. However, fixed cost may be changed because of the other factors such as advertising campaigns, change in property tax rates, changes in factory supervisors' salaries. So changes in fixed costs affects the break-even point as follows. So if the fixed cost increases, so then the break-even also increases. So malaki yung potential pag in-increase yung fixed cost mo. So malaki yung possibility na yung magkaroon ka ng break-even. So malaking tsansa. So mag-increase din yung break-even point niya. While kung if you decrease your fixed cost, so malayo siya sa possibility na magkaroon kayo ng break-even. Kasi you decrease your fixed cost. So to illustrate, assume the Bishop Company is evaluating a proposal to budget an additional of $100,000 for advertising. So we have here the following: the unit selling price of $90, Uh, we have the present $90 while the have the proposal of nine the same as 90, the unit variable cost of 70, uh, same as the variable cost also 70 for the proposed. The unit contribution margin, of course, 90 minus 70 is also is 20, while in the proposed budget, same with $20. But what what is change here is the fixed cost. So sa ngayon is yung ito yung fixed cost nila 600,000. Pero sa proposal budget nila is nagiging 700,000 na. So ano yung effect of changes in fixed cost? To illustrate, assume that Bishop Company is evaluating a ito yung uh, proposal na budget of additional na 100,000 sa $100,000 for advertising. So, break-even sales units equals to fixed cost over the unit contribution margin. So, sa present na budget nila, 600,000 divided by the unit contribution margin of $20. So, mayroon siyang break-even sales in units of 30,000 units. So, while doon sa proposed nila na fixed cost of $700,000, kung kunin natin yung break-even units niya, so divided by $20 unit contribution margin, so that will make a 35,000 units, the break-even sales, kung if they will increase the fixed cost of $700,000. So, the more na mag-increase yung fixed cost, the more na tataas din yung break-even sales uh, in units. So next, we have the effect of changes in unit variable cost. Change in unit variable cost affects the break-even point. So if the variable cost increases, kung tataas yung variable cost, so then the break-even point niya is tataas din. So it also increases. So malaki yung potential na magkakaroon ka ng break-even kung yung unit variable cost mo is increases. So while if you decrease your unit variable cost, so malayo ka na magkaroon ng breakdown or break-even point or break-even. So assume that Park Company is evaluating a proposal to pay additional 2% commission on sales to its salespeople. So, as an incentive to increase sales as follows. So, unit selling price of 250. So, ito yung sa ngayon, while sa kanilang proposal is same din, walang nagbago. So, unit variable cost, 145. So, since mayroon siyang proposed na 2% commission. So, yung variable cost maging 150. 150. So, unit contribution margin, we have 250 minus 145. So, we have 105. So, while sa kanilang proposal, 250 minus 150 is 100 unit contribution margin. So, fixed cost, the same din sa ngayon at saka proposal nila. So, uh, next is ano ba yung what is the break-even sales in units before the additional 2% commission in 8,000 units. So break-even sales, fixed cost over the contribution margin, we have the 840,000 divide 105. So dito sa 8,000 units, dito yung may malaking possibility na magkaroon tayo ng break-even sales in units. So while uh, while sa kanilang proposal na additional 2% commission, so ito na yung FARC's break-even point after na nagkaroon ng 2% additional uh, proposed commission uh, for 8,000 units. We have the break-even sales equals to fixed cost over unit contribution margin. So 840,000 over 100. So we have 8,400 units. Dito yung magkaroon tayo ng break-even sales in units after na nag-propose sila for additional 2% commission in 8,000 units. So, the effect of changes in unit selling price. So, the change in unit selling price affects the contribution margin and thus the break-even point. So, dito, if the unit selling price increases, then the break-even price ma-decrease yung break-even point niya. While kung yung unit selling price natin is bababa, tataas din yung break-even point niya. So, fixed costs do not change in total. Iba pala. So, unit variable costs do not change with changes in the level of activity. However, unit variable cost may be affected by other factors such as changes in the cost per unit of direct materials, changes in the wage rate for direct labor, or changes in the sales commission paid to salespeople. So increases in unit variable cost increases the break-even point. Sabi ko kanina. So decreases in unit variable cost also decreases increases ito pala increases the increases the unit selling price, decreases the break-even point, while decreases in the unit selling price increases the break-even point. So, ang sabi dito sa changes in the fixed selling price is changes in the unit selling price affect the unit contribution margin and thus the break-even point. Specifically, changes in the unit selling price affect the break-even point. So to illustrate, assume the Graham company is evaluating a proposal to increase the unit selling price of its product from $50 to $60 as follows. So the unit selling price of 50 Ito yung sa ngayon, mayroon silang proposal na 60. Tinataasan nila yung unit selling price. So, unit variable cost of 30, the same sa proposal na 30. So, unit contribution margin of 30. Also, yung proposal nila is nagiging 30 din. So, fixed cost, same yung fixed cost, 600,000. So, tingnan natin. Graham break-even point before the price increase is in 30,000 units. We have 600 over 20. So, we have 30,000 units. While after na nag-increase sila, so ito yung break-even point after na nag-increase sila ng 20,000 units. So, 600 over 30. So, the break-even sales is 20,000. So, mas bumaba yung break-even sales. Kasi yung unit contribution margin nila is uh, nagiging $30. So, ito yung, I think that ends my slides. So, yung next na topic is i-discuss sa next reporter, Sir Anthony. Thank you.
Good evening, classmates. In continuation in chapter 4 from the report of Sir Marvin and Sir Jonas, today I'm going to discuss the graphic approach to cost volume profit analysis. In this discussion, we're going to know the objective of this presentation, the definition of the graphic approach to CVP analysis. So, getting the break-even point of the cost volume profit using the chart or the graph, use of computers in cost volume profit analysis, assumption of cost volume profit analysis, and sample analysis. So, at the end of the discussion, we'll be able to how to create the graph and use it for CVP analysis, determine the break-even point using the graphical approach, using two line equations to create the graph and get the break-even point. This is a supplemental discussion in addition to the graphical approach if you find alternative way from getting the break-even point. CVP analysis in terms of changes of fixed costs or variable costs or selling price and volume. And lastly, we will discuss the key assumptions in cost volume profit analysis. In this graph, you will see the total cost. This is we call it line 1, and then the total sales or revenue, we call it line 2. So the green shaded area is our operating profit. So any sales going to this area as good profit margin, and the lower part is the operating total loss. So we're going to demonstrate on how to create this graph based on example from the textbook. So a cost volume profit chart, sometimes a break-even chart, so graphically shows the sales, cost, and related profit or loss for various levels of units sold. It assists in understanding the relationship among sales, cost, and operating profit or loss. To illustrate the CBP chart, in the first graph is based on the following data for Munoz Corporation. So in this example, total fixed cost is 100,000, unit selling price is 50, unit variable cost is 30, and unit contribution margin is 20. So by using this data, we'll see or get the break-even point analysis using the graph. So from the data, we will create a table, use them to plot in the graph. So what we will do is we will only just multiply the units sold per unit selling price. So in the exact example, we will only divide it into per every 2,000 units sold. So if 0 units sold, so of course we don't have sales revenue. And if 2,000 units sold, so multiply it by 50, so equals to 100,000. The third column is 4,000 units sold times 50 is 200,000, and so forth. The variable cost is also you just multiply it to unit variable cost. Let's say sold to 60,000, 120,000, 180, 240, and 300. The fixed cost will remain constant. Now if I'm going to add all the unit costs, I mean the total cost, so the sum will be 100,000. 60 plus 100 is 160, 120 plus 100 is 220,000, 180,000 plus 100,000 is 280,000, and so forth. Okay, we will plot the graph using the x-axis and the y-axis. So let x-axis as the unit sold, and the vertical axis, let's call it y-axis, or the sales revenue. So here we will calibrate or graduate scale this one into per 2,000 units sold. So this is 2,000, 4,000, 6,000, 8,000, and 10,000. The vertical axis or the y-axis is correspond to your sales, so we will scale this into per 100,000. Okay, so to make the graph, so this first column, the 0 units sold and 0 sales revenue, can be seen in the origin where it's there's a red dot point, and we will just connect with the other 1 point. So I will use the 10,000 units sold corresponding to 500 units sold. So this one, 10,000 and 500,000 units sold. So here is the red dot. I'm just going to connect this one. So vertically, just to simplify the 10,000 and 500,000. And then I'm going to connect both points. And we'll call it the first line. So this one we call it sales line or the revenue line. So in the total cost line, we will use the since the other line will be representing the total cost, we will use the first points, the unit sold 0, well, of course, when you start the business, the fixed cost will be present even there's not yet a sales revenue offered. So I will use the 0 and then 100,000 total cost. And you can see in the vertical axis there's a red dot there representing the 0 unit sold and 100 total cost. And we will get another line, just another point to create a new line. So I'm going to use the 10,000 units sold and the 400,000 total cost. So here is the second point, and then I'm going to connect these 2 points to create another line. Okay, so using your ruler or any vertical, you can just scale this one and get the points, and then we call this one as line 2 and line 1. Okay, from this graph, the intersection of these 2 lines is what we call the break-even point. So to get the break-even point, so we just scale this one and check vertically, draw a line vertically and horizontally, and you will get this one. In this graph, you will see it's in between 4,000 and 6,000, so it is 5,000 units sold, and in the sales axis is 250,000. So at break-even point, the Munoz Corporation should sold 5,000 unit. Okay, if you find using the graphical method difficult because of the scaling concern, then we can create a line equation out from this graph. Remember, in the linear algebra, when 2 lines intersecting, that intersection point can be calculated through using the line equation, 2-line equation. So break-even point analysis using algebra line equation. So at point 0, it is the origin. So at this point, it is 0, 0. The P1 is the 10,000 units sold and 500,000 sales. So you can see in the graph, it's where located the P1. The P2 also is located in the vertical axis, where 0 and 100,000. The P3 also is located in the 10,000 units sold and 400,000 sales. So we are going to find the break-even point, or the point BE. So in linear algebra, we just get the slope. We find first the slope and then create a line formula. So for slope of line 1, it is the vertical height over horizontal length, that is 500,000 over 10,000. So the slope of line 1 is 50. So using the linear algebra, line 1 is using this standard formula, y minus 500,000. 500,000 corresponds to y1 equals to the slope, which is 50, times x minus x1 over the 10,000. Or to simplify this one, we have equation 1 of y equals to 50x. We will note this one as equation 1. For line 2, same procedure, we will get the slope. So vertical height is 400,000 minus 100,000 over 10,000. So the slope of line 2 is 30. Using this slope value, we can create a second line by using the standard line formula. So y minus y2 equals to slope times x minus x2, or y minus 100,000 equals to 30 times x minus 0. Or to simplify, x equals to 3x plus 100,000. This is, we will note this one as equation 2. But since at break-even point, these 2 lines will intersect, So it means that the value of x and y in this point is equal. So we will equate equation 1 to equation 2, which is equation 1 equals to equation 2, or 50x equals to 3x plus 100. To simplify this one, so we transfer 3x to the left side, so the remaining is 20x over 100,000 equals 100,000. Then solve for x. 100,000 divided by 20 equals to 5,000, which is the same with the graphical analysis. So using equation 1, y equals to 50x equals to 50 times 5,000 equals to 250,000. So which is the same in the graphical approach. Okay, in this example, we will notice or observe the significant effect of changing the fixed cost in this example. So from the previous example, we used the 120,000 fixed cost. Oh no, 100,000. Now we add it with 20,000 to make it is 120,000. So the total cost will now change, but your revenue line will keep the same. So in this example, the break-even point will move up to 6,000 and 300,000. And to verify this one, I will use linear algebra. So in this case, the result is the same. At break-even point, equation 1 equals to equation 2. So we solve for value of x equals to 6,000, and the value of y, which is the sales revenue, is 300,000, which is the same. The assumption of cost volume profit analysis. So in this analysis, it depends on several assumptions. The primary assumptions are as follows. So total sales and total costs can be represented by straight line. So it's linear. It is within relevant range and operating activity, and efficiency of operation does not change. Cost can be divided into fixed and variable components. The sales mix is constant. Since this is linear, it is assumed that the revenue, or it is all are sold, which is true in the last assumption, that there's no change in inventory quantities during the period. So in this kind of analysis, the assumption is that all your inventory in the end, it is sold. That's all for my presentation. Thank you.
So, to continue the discussion of cost behavior and cost volume profit analysis, so I will be discussing the topic, which is special cost volume profit relationship. So, cost volume profit analysis can also be used when a company sells several products with different costs and prices. So, in addition, operating leverage and the margin of safety are useful in analyzing cost volume profit relationships. So, sales mix considerations. So, many companies sell more than one product at different selling prices. So, in addition, the products normally have different units, variable cost, and different unit contribution margins. So, in such cases, break-even analysis can still be performed by considering the sales mix. So, sales mix is the relative distribution of sales among the products sold by a company. So, to illustrate and assume that we have this Cascade company sold product A and B during the past years as follows. So, the total fixed cost is 200,000. So the unit selling price for product A is $90, for product B is $140, and unit variable cost for A is 70 and 95 for B. So we will subtract the selling price 90 and variable cost 70. So that would result to 20% at $20 the unit contribution margin. So same with product B. The result is $45. The sales mix for product A and B is expressed as a percentage of total units sold. So how do we compute the sales mix for product A and B? So we will just add the units sold for A, which is 8,000, and plus 2,000 for product B. That would result to 10,000. So therefore, the sales mix for product A is 80% and 20% for product B. So for Cascade Company, the unit selling price, unit variable cost, and unit contribution margin for E are computed as follows. So for break-even analysis, it is useful to think of products A and B as components of one overall enterprise product called E. The unit selling price of E equals the sum of the unit selling prices of each product multiplied by its sales mix percentage. So we will just so to come up with the unit selling price of E na $100, i-multiply lang ang product A and B. Ang product A, I mean, $90 times 0.8, which is mo to ang sales mix nga 80%. And for product B, $140 times 0.20, mo po to iyang sales mix nga 20%. That would result to $100 to $100. So same computation with unit variable cost of E, and that would result for the unit contribution margin of E is $25. So to compute the break-even point, so example, Cascade has total fixed cost of $200,000. So that can be determined as follows using the unit selling price, unit variable cost, and unit contribution margin of E. So fixed cost, which is $200, and unit contribution margin is $25. So we will just divide the $200,000 to 25. So that would result 8,000 units. So that would be the break-even point. So because the sales mix of product A and B, so ang A is 80% man and B is 20%. So the break-even quantity of A is 6,400 units. So gi-multiply lang ang 8,000 times 80%. So same with product B, ang total niya is 1,600 units. So gi-multiply lang pod ang 8,000 units to 20%. So in the exhibit, as you can see, the preceding break-even analysis is verified. So next is operating leverage. So what is operating leverage? So it is a measure of how sensitive net operating income is to percentage changes in sales. So it is a measure at any given level of sales of how a percentage change in sales volume will affect profits. So the learning objective for this is to compute the degree of operating leverage at a particular level of sales and explain how it can be used to predict changes in net operating income. So the relationship between a company's contribution margin and income from operations is measured by operating leverage. So a company's operating leverage is computed below. So compute contribution margin over income from operations, and that would result to operating leverage. So the difference between contribution margin and income from operations is fixed cost. Thus, companies with high fixed costs will normally have high operating leverage. So examples of such companies include airlines and automotive companies like Ford Motor Company. So the low operating leverage is normal for companies that are labor intensive, such as professional service companies, which have low fixed costs. So to illustrate operating leverage, assume the following data for Jones Inc. and Wilson Inc. So as shown, Jones and Wilson have the same sales, so 400,000, the same variable cost, which is 300,000, and same contribution margin, which is 100,000. So however, Jones has larger fixed cost than Wilson. So ang fixed cost ni Jones is 80,000 compared to Wilson, which is 50,000. So the operating leverage for each company is computed as follows. So in the next slide, in this slide, we will just divide the contribution margin over income from operations. So 100,000 divided by 20,000. So what would result to 5. So that would be the operating leverage for Jones. So same formula with Wilson. So the result for Wilson is 2. So operating leverage can be used to measure the impact of changes in sales on income from operations. Using operating leverage, the effect of changes in sales on income from operations is computed as follows. So percentage change in sales times operating leverage. So the result that would result to percent change in income from operations. So to illustrate, assuming the sales increase by 10% or 40,000, so 400,000 times 10% for Jones and Wilson. So the percent increase in income from operations for Jones and Wilson is computed as follows. So for Jones Inc., so we will just multiply the percent change in sales, which is 10%, times operating leverage, which is 5. So that would result to 50% change in income from operations for Jones Inc. Same with Wilson Inc. So that results to 20% of percent change in income from operations. So as shown, Jones' income from operations increases by 50%, while Wilson's income from operation increases by only 20%. So the validity of this analysis is to shown in the following income statements for Jones and Wilson based on the 10% increase in sales. So the preceding income statements indicate that Jones' income from operations increased from 220,000 to 30,000, or a 50% increase. In contrast with Wilson's income from operations increased from 50,000 to 60,000, or a 20% increase. Because even a small increase in sales will generate a large percentage increase in income from operations, Jones might consider ways to increase sales. Such actions could include special advertising or sales promotions. In contrast, Wilson might consider ways to increase operating leverage by reducing variable costs. So, the impact of a change in sales on income from operations for companies with high and low operating leverage is summarized in this exhibit. So in this exhibit, so the operating leverage is high. So the percentage impact on income from operations from a change in sales is large. So when the operating leverage is low, so small po ang percentage impact on income from operations from a change in sales. So next is we will be discussing the margin of safety. So it indicates the possible decrease in sales that may occur before an operating loss results. Thus, if the margin of safety is low, even a small decline in sales revenue may result in an operating loss. So, the learning objective for this is to compute the margin of safety and explain its significance. The margin of safety may be expressed in the following ways. So first is dollars of sales, second, units of sales, third, percent of current sales. So the margin of safety in dollars is the excess of budgeted or actual sales over the break-even volume of sales. So to illustrate, assuming the following data, so sales is 250,000, sales at break-even point is 200,000, and the unit selling price is 25. So the margin of safety in dollars of sales is 50,000. So how do we know how do we compute that is 250,000 minus 200. So the margin of safety in units is 2,000 units. So we just divide the 50,000 to 25 unit selling price. So the margin of safety expressed as a percent of current sales is 20%. So how do we compute it? So first is sales, which is 250,000 minus sales at break even point na 200,000. So that would result to 50,000. So divide the sales 250,000. So that would result to 20% of margin of safety. So therefore, the current sales may decline 50,000 to 20,000 units or 20% before an operating loss of